Good morning and welcome to the Killik podcast for Friday the 26th of June. After a strong start to the week for markets on Greek concessions, we've had 4 failed attempts to reach an agreement and we go into Saturday with a final deadline set. So the Greeks must accept a compromise proposal or be presented with a take it or leave it answer to their issues. The market continues to expect some sort of deal for this 7.2 billion euro payment. This is principally on the basis that both sides have far more to lose. So the EU institutions hold around 65% of Greek debt, which is worth about 200 billion euros. And clearly the Greek population, you've seen it in the news programs, want to stay in the Eurozone. And recent television polls showed that 75% of Greeks want to stay in the Eurozone. We continue to watch the euro with interest. Having seen the euro weakened quite substantially after the announcement of QE. This is against the dollar. We've seen it being actually very firm and rise against the dollar during this Greek crisis, which seems slightly perverse. The reason for that is the relative growth rates of the two economies have changed. So there's been inflection where Europe has accelerated and the US has decelerated. And this week we saw further evidence of strong European growth in the PMI data that came out. We've got a composite PMI of 54.1, which is the highest we've seen in Europe for 49 months. So that was very encouraging. The other thing to note about this is that we're obviously seeing stronger European markets, but a lot of that to date has been negated by a weaker currency. Now you're getting stronger European markets and a stronger currency, which is a very good position for sterling returns. The other area of great interest this week has been the Shanghai market. So that fell 7.4% last night. It's now off around 20% off the top. And that is following tighter rules over margin trading and the leverage that retail investors can access in the grey market. Now, the level of leverage here can be up to over 5 times, which is a very high level of leverage, where 20% of fallen capital will wipe out your capital in its entirety. Clearly, the boom in the Shanghai market this year, so it's doubled year to date, has been against a worsening economic situation in China, and it's been sort of quite puzzling for us to watch. And part of it, the explanation for this, I think, has to be in the fact that it's been a speculative fueled rally. We've seen a surge in new retail accounts, so we've seen 60,000 a week. Used to be signed up in mid-2014, rise to around 2.5 million in April 2015. So huge amount of interest from retail investors. And the level of activity has been massive. So the turnover in the Shanghai Composite is around 7% per day. So that's 7% of the entire market capitalization is traded every day. That accounts to the entire market being bought and sold more than 12 times in a year, which is very, very speculative and very frothy. So we've been discussing labour market a lot recently, and the tightening labour market, the reduction in the capacity in the labour market, and that negative impact that wage inflation could have on margins, and the need for productivity to rise. Here we've got a chart from the MPC in their May inflation report that just shows the GDP rise, that blue line that we've had over the last couple of years since the crisis. And what has actually contributed to that GDP rise. So whether it's been increased hours worked or increased productivity. As you can see from here, it's pretty much all increased hours. So the MPC goes into a little bit of detail to explain the absence of productivity growth. And they're talking about 3 main issues here. Firstly, that most of the new jobs that have come in since the great financial crisis or crash have been the low-skilled, less productive part of the workforce. Secondly, they said that low rates in the economy has allowed inefficient businesses to remain operational, and therefore you're not getting this weeding out of the weaker businesses. And further, weak investment in physical and tangible skills have hindered companies' ability to adopt more innovative processes. So we think that's on the change now, and that's why we're looking at companies that address these issues for businesses or are already addressing it in their own businesses. Next week we have Ocado reporting, and this is a company that we do feel has a comparative advantage in this space because of its high levels of automation in the business. Ocado continues to offset the price reductions we're seeing in groceries in the UK, because we're going through a grocery food war at the moment in terms of prices with the supermarkets. They're offsetting those lower prices with leverage gains. So we're seeing a steady rise in profitability despite the price wars. We continue to believe that they will have an advantage over the legacy operators because they don't have the store portfolio that is now hindering people like Tesco's and Sainsbury's, and we continue to feel that groceries will shift strongly online, and that process has only just begun. So looking ahead next week, as I say, we've got Ocado on Tuesday. We've also got Imagination Technologies on Tuesday. We'll talk a little bit about that next. On Wednesday, we've got Tullow and Green King, and Thursday, Lowe & Bonner. So again, a fairly light week. On Imagination Technologies, we expect these results to be broadly in line. The company would have known their licensing number at the end of May, so had it been bad, they would have had to have told the market. It's just interesting to look at this business in terms of what they've invested over the last 5 years. So IMG invested £750 million in R&D, capex and acquisitions, which is 1.25 times the market cap. So that's been a huge upfront investment in the Internet of Things. At the moment, the business currently spends around 70% of its revenue on R&D, and a good example of where they're trying to get ahead of the curve is they've got 300 people developing their connectivity technology IP, which is not selling at the moment. It's pre-royalty stage. So there's a huge amount of upfront investment that's not being reflected in the earnings at the moment. So therefore, the business is highly operationally geared into what we think is a very big expanding market opportunity. So because we haven't seen the proof of the pudding in terms of results from this R&D spend, the multiple that IMG continues to trade on is at a significant discount to the rest of the industry. So if you look at IMG on an EV to sales basis, which is 3.3 times, that's against 15.7 for ARM. So for us, the relative risk reward looks in favour of Imagination Technologies. Anyway, that's it from me. Have a good weekend. Thanks for listening.